quick note: this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. When traders talk about edge, most of them are referring to something they believe gives them an advantage over the market. The problem is that in the majority of cases, what they call an edge is nothing more than a pattern they have seen work a few times. That is not edge, that is observation without statistical grounding. A real edge is not something that feels convincing. It is something that produces positive expectancy over a large sample of trades, regardless of individual outcomes. You need to understand this clearly. Edge is not about being right more often than you are wrong. Edge is about making more money when you are right than you lose when you are wrong, combined with a probability structure that supports that outcome over time. This is why many professional traders can have win rates below 50% and still generate consistent returns. Their edge is embedded in the structure of their trades, not in their ability to predict direction. The market does not reward opinions. It rewards structured risk-taking where the payoff distribution is asymmetric. If your approach does not produce that asymmetry, then you do not have an edge, regardless of how confident you feel in your analysis. One of the most dangerous misconceptions in trading is the belief that accuracy equals edge. Traders become obsessed with being right. They focus on entry precision, timing the exact top or bottom, and validating their views. This creates a psychological dependency on outcomes rather than on process. A professional does the opposite. They detach from the need to be right and focus entirely on expectancy. Expected value is the foundation of edge. It is the mathematical expression of whether a trading strategy makes money over time. If you do not understand your expected value, then you are not trading with an edge. You are speculating without structure. Expected value combines three core elements: your win rate, your average win size, and your average loss size. The relationship between these variables determines whether your approach is profitable. You can have a high win rate and still lose money if your losses are too large. You can have a low win rate and still be profitable if your winners are significantly larger than your losers. This is the shift you need to make. Stop asking whether a trade will work. Start asking whether the structure of your trades produces positive expectancy over time. Real edge is always grounded in something structural. It is not random and it is not purely visual. It comes from understanding how markets actually function. This includes liquidity dynamics, participant behavior, and the incentives that drive price movement. For example, institutions do not trade the same way retail traders do. They need liquidity to enter and exit positions. This creates predictable behaviors around certain price levels. Stop runs, liquidity sweeps, and false breakouts are not random events. They are a consequence of how large players operate. If your strategy is aligned with these structural realities, you are beginning to move towards real edge. If your strategy is based purely on patterns without understanding why those patterns exist, then you are operating in illusion. Edge is not about seeing something others cannot see. It is about understanding something others do not understand. That distinction is critical. Another key aspect of edge is repeatability. A true edge must be repeatable across different market conditions and over a large number of trades. If something only works occasionally or under very specific conditions that you cannot consistently identify, then it is not a reliable edge. Many traders fall into the trap of overfitting. They analyze past data, identify patterns that worked historically, and assume those patterns will continue. The issue is that markets are adaptive. What worked in one regime may fail completely in another. This is why professional traders focus on principles rather than fixed patterns. They build frameworks that adapt to changing conditions. Their edge is not tied to a single setup. It is embedded in how they interpret and respond to market information. If your strategy cannot survive different market environments, then it is not robust, and if it is not robust, it is not an edge. You also need to consider the role of competition. Markets are highly competitive environments. If an edge is obvious, it will not last. As more participants exploit the same opportunity, the edge diminishes and eventually disappears. This process is known as edge decay. It is a natural consequence of market efficiency. Any persistent inefficiency attracts capital, and that capital eliminates the inefficiency over time. This is why relying on widely known strategies is problematic. If everyone is using the same indicators, the same signals, and the same entry points, then there is no edge. At best, you are participating in a crowded trade. At worst, you are providing liquidity for more sophisticated players. A professional constantly evaluates whether their edge still exists. They monitor performance, analyze outcomes, and adjust their approach when necessary. Edge is not static. It evolves, and you must evolve with it. Let's address the concept of backtesting, because this is where many traders convince themselves they have an edge. Backtesting can be useful, but it is also one of the most misunderstood tools in trading. A backtest shows you how a strategy would have performed under historical conditions. It does not guarantee future performance. Markets change, conditions shift, relationships break down. More importantly, backtests are highly sensitive to assumptions. Small changes in parameters can produce dramatically different results. This creates a risk of over-optimization, where a strategy is tailored to fit past data perfectly, but fails in live trading. A real edge should be evident not just in backtests, but in forward performance. It should survive live execution, slippage, and changing conditions. If your edge only exists in a spreadsheet, it is not an edge, it is a model. Another dimension of edge is execution. Even if you have a valid strategy with positive expectancy, poor execution can destroy that edge completely. This includes timing, position sizing, and trade management. For example, entering too early or too late can significantly impact your risk-reward profile. Oversizing positions can expose you to unnecessary drawdowns. Failing to cut losses quickly can turn small losses into large ones. Edge is not just what you trade, it is how you trade it. The same strategy can produce very different results depending on execution quality. This is why professionals place so much emphasis on process. They define clear rules for entry, exit, and risk management. They remove as much subjectivity as possible. Their goal is to ensure that their edge is consistently expressed in the market. Let's talk about illusion. Illusory edge is everywhere in trading. It often feels real because it is supported by short-term success. A trader might experience a series of wins and conclude that they have found something that works. In reality, they are experiencing variance. Random outcomes can produce streaks of success or failure that have nothing to do with underlying edge. This is where discipline becomes critical. You need to evaluate your performance over a sufficiently large sample size. A handful of trades means nothing. Even 50 trades can be misleading. You need hundreds, sometimes thousands, to truly assess whether an edge exists. If you base your conclusions on small samples, you are operating in illusion, and that illusion will eventually break, usually at the worst possible time. Edge is also closely linked to selectivity. Not every trade opportunity is equal. A professional does not trade constantly. They wait for situations where their edge is strongest. This requires patience and restraint. It also requires a clear understanding of what constitutes a high quality setup. Without that clarity, you end up taking marginal trades that dilute your overall expectancy. Think of your capital as finite. Every trade you take is an allocation decision. If you allocate capital to low quality opportunities, you reduce your ability to capitalize on high quality ones. This is where many traders struggle. They feel the need to be active. They equate activity with productivity. In reality, activity without edge is just noise. Ultimately, edge is not a single concept. It is a combination of factors working together. It includes your strategy, your risk management, your execution, and your psychological discipline. You cannot isolate one component and expect consistent results. A strong strategy with poor risk management will fail. Good execution without a valid strategy will fail. Psychological instability will undermine everything. A professional integrates all these elements into a cohesive framework. Their edge is not fragile. It is robust because it is supported by multiple layers of structure. This is the standard you need to aim for. Not a single setup that works occasionally, but a complete system that produces consistent outcomes over time. Edge is not something you find, it is something you build, refine, and protect. To deepen this further, you need to separate the idea of having an edge from expressing that edge. These are not the same thing. Many traders believe they lack an edge, when in reality they have a fragile edge that they consistently fail to execute properly. Others believe they have a strong edge when in fact they are simply experiencing favorable variance. Expression is everything. A strategy might have a theoretical positive expectancy, but if you cannot execute it consistently, the realized outcome will be negative. This is why professional trading is less about discovering something magical and more about ensuring consistent alignment between decision, execution, and risk. You need to ask a more precise question. Not do I have an edge, but am I expressing my edge consistently across a large sample of trades? If the answer is no, then the issue is not necessarily the strategy. It is the breakdown between intention and action. One of the most overlooked sources of real edge is information asymmetry, not in the sense of insider information, but in how information is interpreted and prioritized. The market is flooded with data, economic releases, news headlines, technical signals, sentiment indicators. Most traders consume the same information. The difference lies in interpretation. Professionals do not treat all information equally. They filter aggressively. They understand which variables matter in the current regime and which ones are noise. For example, in a high inflation environment, monetary policy expectations dominate. In a low growth environment, recession risk becomes the primary driver. If you are applying the same framework across all conditions, you are missing the point. Edge comes from contextual understanding, knowing what matters now, not what mattered before. This is where most traders fall behind, because they operate with static models in a dynamic system. Another critical component is behavioral edge. This is often misunderstood. Behavioral edge is not about being smarter than other traders. It is about being more disciplined and more consistent in your actions. Markets are driven by human behavior: fear, greed, panic, overconfidence. These forces create inefficiencies. If you can remain stable while others are reactive, you gain an advantage. For instance, during periods of high volatility, many traders make impulsive decisions. They chase price, they over-leverage, they abandon their plans. A disciplined trader who sticks to predefined rules can exploit this behavior. Behavioral edge is subtle but powerful. It does not rely on predicting the market. It relies on responding correctly while others respond incorrectly, while others respond incorrectly. You also need to understand that edge exists at different time horizons. A short-term trader and a long-term macro investor operate with completely different types of edge. Neither is inherently superior, but each requires a different framework. Short-term edge often comes from microstructure, liquidity, and execution. It is about exploiting short-lived inefficiencies. This requires speed, precision, and a deep understanding of order flow. Long-term edge is more about macro alignment, fundamental trends, and patience. It involves positioning for larger moves over extended periods. This requires conviction and the ability to withstand drawdowns. Problems arise when traders mix these approaches, trying to apply short-term logic to long-term trades, or vice versa. This creates inconsistency and erodes edge. You must define your time horizon clearly. Your edge must align with that horizon. Let's address consistency, because this is where edge becomes meaningful. A single profitable trade proves nothing. Even a profitable month proves very little. Consistency over time is the only reliable indicator of edge. This requires rigorous tracking. You need to record your trades, analyze your performance, and identify patterns, not just in outcomes, but in decision making. Which setups perform best? Under what conditions do you perform poorly? Where are the leaks in your process? Without this level of analysis, you are operating blindly. You might have an edge, but you will not know how to optimize it. Or worse, you might think you have an edge when you do not. Professionals treat trading like a data-driven process. Every trade is feedback. Every outcome is information. There is also a misconception that edge must be complex. In reality, many effective edges are relatively simple. The complexity lies in execution and consistency, not in the strategy itself. Simple does not mean easy. A straightforward trend-following approach, for example, can be highly effective, but it requires discipline to hold positions through volatility, to accept drawdowns, and to avoid overtrading. Traders often complicate their strategies in an attempt to increase accuracy. They add indicators, filters, and conditions. This can reduce clarity and introduce conflicting signals. A complex strategy does not guarantee an edge. In many cases, it reduces it. Clarity and repeatability are far more valuable than complexity. Another important concept is robustness. A robust edge performs reasonably well across different conditions. It may not perform optimally in all environments, but it does not break down completely. Fragile edges, on the other hand, perform well under specific conditions, but fail when those conditions change. These are dangerous because they create a false sense of confidence during favorable periods. You need to stress test your approach, not just in backtests, but conceptually. Ask yourself how your strategy would perform in different regimes. High volatility, low volatility, trending markets, range-bound markets. If your edge depends on a very specific set of conditions, then you need to be highly selective. Otherwise, you will be exposed when the environment shifts. Let's bring this back to risk, because edge without risk control is meaningless. You can have a positive expectancy strategy and still lose money if your risk management is poor. Risk defines how your edge is expressed over time. It determines the variability of your returns, the size of your drawdowns, and your ability to survive losing streaks. This is where many traders fail. They focus on finding an edge, but ignore how that edge interacts with their capital. They take excessive risk, they increase size after wins, and they panic during losses. A professional understands that edge and risk are inseparable. The goal is not just to have an edge, but to survive long enough for that edge to play out. There is also the concept of meta edge. This is the ability to adapt, learn, and evolve faster than the market changes. In a constantly shifting environment, this becomes one of the most valuable advantages. A trader with meta edge does not rely on a fixed strategy. They continuously evaluate their performance, identify changes in market behavior, and adjust accordingly. This requires humility. You must be willing to accept that what worked before may not work in the future. You must be willing to question your assumptions and refine your approach. Meta edge is what separates long-term professionals from those who experience temporary success. It is not about finding a perfect strategy. It is about staying relevant as the market evolves. At this stage, you should be starting to see that edge is not a single discovery. It is a layered construct. It combines structural understanding, probabilistic thinking, disciplined execution, and continuous adaptation. If any of these layers are missing, the overall edge becomes weaker. This is why many traders struggle. They focus on one aspect, usually strategy, and ignore the rest. A professional builds a complete system. They understand where their advantage comes from, how it behaves under different conditions, and how to execute it consistently. This is the standard required to operate at a high level, not occasional success, but sustained performance driven by a well-defined and well-executed edge. At this point, it is essential to confront a reality that most traders avoid. You may not currently have an edge, and more importantly, you may not even know whether you do or not. This is not a criticism. It is simply the starting point for most participants in the market. The danger lies in assuming edge without evidence. When you assume you have an advantage, you increase size, you take more risk, and you become less objective. This is where significant losses tend to occur. Confidence without statistical backing is one of the most expensive mistakes in trading. The correct approach is to treat edge as something that must be proven, not believed, not assumed, but demonstrated through consistent performance over time. Until that evidence exists, you operate with caution, smaller size, controlled exposure, and a focus on data collection rather than profit maximization. This mindset protects your capital while you develop and validate your approach. Validation is the next step. Once you have a strategy or framework, you need to test whether it actually produces positive expectancy. This is not a one-off process, it is continuous. You begin by defining your setup clearly. What conditions need to be present? What is the entry logic? Where is the invalidation point? What is the target structure? If these elements are not clearly defined, you cannot test anything properly. Then you execute consistently. This is critical. If your execution is inconsistent, your results become meaningless. You cannot distinguish between a flawed strategy and flawed execution. Over time, you build a dataset. This dataset becomes the foundation of your analysis. It allows you to measure performance objectively, identify strengths and weaknesses, and refine your approach. Without validation, everything remains theoretical. Another layer to consider is scalability. Not all edges scale. Some strategies work well with small position sizes, but break down when size increases. This is particularly relevant in markets where liquidity becomes a constraint. Even in retail trading, there is a version of this. As you increase size, your psychological response changes. Your decision making can become less stable. This effectively reduces your ability to express your edge. Professionals are always aware of scalability. They understand the limits of their strategies. They adjust position sizing based on liquidity, volatility, and their own psychological capacity. An edge that cannot be scaled appropriately is limited. You need to understand those limits clearly. Let's address another subtle but important point. Edge is relative. It is not absolute. You do not need to be perfect. You only need to be better than the average participant in the market. This shifts your perspective. You are not trying to predict every move correctly. You are trying to operate with slightly better decision making, slightly better risk control, and slightly better discipline than the majority. Over time, these small advantages compound. This is how professional performance is built, not through perfection, but through consistent marginal gains. This also means that your edge does not need to be extraordinary. It needs to be real, repeatable, and protected. Protection of edge is something rarely discussed, but it is critical. Once you identify a working approach, your priority shifts from discovery to preservation. This involves maintaining discipline, avoiding unnecessary changes, and protecting your psychological state. Many traders sabotage their own edge by constantly tweaking their strategy, reacting to short-term losses, or overcomplicating their process. Consistency is what allows edge to manifest. If you keep changing your approach, you never allow the probabilities to play out. You also need to be aware of external influences. Social media, other traders, and market noise can distort your thinking. Protecting your edge means maintaining clarity and independence in your decision making. Another dimension of edge is timing, but not in the way most traders think. It is not about perfect entry, it is about aligning with the right conditions. A strong setup in the wrong environment is a weak trade. A moderate setup in the right environment can be a strong trade. This is where context becomes critical. Market regime, volatility, liquidity, and macro drivers all influence the effectiveness of your strategy. Professionals prioritize alignment. They wait for conditions where their edge is most likely to perform. This improves overall expectancy without requiring higher accuracy. You are not trying to force trades. You are waiting for alignment. Let's talk about drawdowns because they are an unavoidable part of any edge. Even a strong strategy will experience periods of underperformance. This does not mean the edge is gone. The key is to distinguish between normal variance and structural breakdown. This requires data, context, and experience. If you understand the statistical profile of your strategy, you will know what a typical drawdown looks like. This allows you to remain composed during losing periods. Without that understanding, every loss feels like a failure of the strategy. This leads to constant changes, which destroys consistency. A professional accepts drawdowns as part of the process. They manage them, but they do not overreact to them. You also need to consider opportunity cost. Every trade you take uses capital and attention. If you allocate resources to low-quality opportunities, you miss higher quality ones. This is why selectivity is so important. A smaller number of high-quality trades is far more effective than a large number of marginal ones. Opportunity cost is not always visible, but it is always present. It shapes your overall performance. A professional constantly evaluates whether a trade is worth the capital and attention it requires. If it does not meet the threshold, it is ignored. This discipline enhances the impact of your edge. At an advanced level, edge becomes integrated into your identity as a trader. It is no longer something you consciously think about on every trade. It becomes part of your decision-making process. This does not mean you become complacent. It means your framework is internalized. Your responses are structured, consistent, and aligned with your edge. This level of integration takes time. It comes from repetition, analysis, and refinement. It is the result of deliberate practice. When you reach this stage, your focus shifts from execution to optimization. You are no longer trying to prove your edge. You are refining how efficiently you express it. To conclude, edge is the foundation of professional trading, but it is often misunderstood. It is not a secret strategy, a perfect indicator, or a predictive model. It is a combination of positive expectancy, structural understanding, disciplined execution, and continuous adaptation. It is proven through data, expressed through consistency, and protected through discipline. Most importantly, it is built over time. There is no shortcut. You develop it through experience, analysis, and refinement. If you approach trading with this mindset, you move away from illusion and towards reality. You stop chasing certainty and start building a framework that can operate under uncertainty. That is what defines a professional trader. Not the ability to predict the market, but the ability to operate effectively within it.